Investors remain increasingly cautious within the fixed income markets at the moment. There is a lot of uncertainty around Greece and the potential timing of bailout negotiations there. There has also been a heightened focus on the potential and the timing of the US Fed rate hikes. What we saw in April and May was a reversal of the sharp rally that we saw in yields in Q4 2014. That rally was really based off a sharp and aggressive fall in the oil price, and we've seen that stabilise more recently, and in line with that we've seen a stabilisation in terms of inflationary expectations. Our returns in corporate bonds have been quite strong coming out of the GFC. With regards to our corporate bond fund, we had a very strong period, sort of 2010 to 2012. So the fund was up 10% in 2010. It was 9% in 2011. We looked at about 11.4% in 2012. 13-14 saw more natural or normal levels of about 6.5%. So we're really targeting bank bills plus 2 to 3% over the cycle, with monthly income guided every 6 months. The key drivers for corporate bonds are really threefold. One is prevailing interest rates, 2 is the financial health of corporates, 3 is global risk appetite more broadly. The key risks in fixed income have been increasing of late. The low yield environment has seen fixed income issuers extending their maturity profile. What has resulted is an extreme lengthening in fixed income benchmarks. This means for benchmark aware investors, the risks posed from rising interest rates are quite material. Another key risk that we've seen is just some of the volatility around the potential or the volatility around the uncertainty in terms of the Greek bailout discussions, but importantly we still see good value in certain sectors and issuers that we like. Our outlook for corporate bonds remains very constructive. We think the ongoing low yield environment globally will continue to support the yield trade. We do, however, think that this or the next leg of the cycle will be less about just being in the asset class or the beta tailwind and being more about stock selection and sector rotation. We currently have a preference for more defensive, non-cyclical industries, those which we think will perform better in the next leg of the cycle and have a more robust outcome.